All right, it is Friday, the end of a long week. We have 30 minutes to go until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Bank earnings, they're rolling in. JP Morgan posts record profits. Citigroup beats on equities trading, and Wells Fargo warns cost-cutting efforts have started to slow.
We get a fresh read on inflation, or got one a half hour ago. U.S. producer prices climbed slightly more than forecast in June. Up next, we're going to get consumer sentiment data from the University of Michigan.
And a defiant Biden strikes again, with the president vowing to stay in the 2024 race despite a series of high-profile missteps. Let's take a look at where markets are trading. About 30 minutes to go until that bell rings. You can see the S&P 500. We're up slightly after that big wipeout we saw yesterday. Currently up about 0.1% in the pre-market. The Nasdaq 100 pretty much unchanged, but of course the color is green. And the bond market even has calmed down a little bit. We're pretty much flat right now, even though we got that slightly hotter than expected PPI, but that's following a big rally yesterday, Matt.
We have had a series of bulls on today already. Janney and Stoltzfus. Now we get Julian Emanuel in a second. He has a target of 6,000 for the S&P. That's here in white. Meanwhile, Ed Hyman at ISI says the economy is slowing. And you can see the surprise index in blue just continues to disappoint. That's what we're going to focus on this morning.
And Matt, if you were looking for the big banks to really drive that S&P 500 higher, you are looking at mixed results. JP Morgan Chase really down 0.6% pre-market. Citigroup on a tear, though, 2.2% higher. Wells Fargo now down almost 6% before the market opened.
All right, so it is Sonali's Super Bowl today. We're going to focus in, of course, on the bank stocks throughout the next couple of hours. And wow, JP Morgan really delivered, knocking the cover off the ball. They did so well that Jamie Dimon said, I don't even need to be on the earnings call.
I'm going to Germany. Don't worry about me. Yeah, you're not necessarily seeing that rewarded in the pre-market action, but you are seeing Wells Fargo punished in a big way. I mean, down nearly 6% just on that net interest income mix.
Yeah, that, and then also that provision for credit losses really at many of the banks, barring Citigroup here, starting to show some signs of trouble, some concerns at least around credit quality, and that's feeding through sentiment.
All right, Julian Emanuel, as I said, is joining us this morning. He is, of course, the chief equity and derivatives strategist and quant strategist at Evercore ISI, the most bullish name on the street of the big names. I mean, a target of 6,000, Julian. And we're so happy you joined us in our inaugural week of this show. We want to tell the story of the macro through the micro. Can you do that with Sonali's banks this morning? Can you look at Wells Fargo, at JP Morgan, at Citi, and tell the story of this economy?
Well, you can if you actually look. So they're basically telling you, on a broad sense, that business is still good, okay? Yeah, we're worried about net interest margins and so on, but the flip side of that is we still haven't had a capital market cycle. So we've got that to look forward to. That's the backdrop. But when you look at it, it is the story of what we've seen for several quarters in a row in terms of earnings. One stock's going one way, the other stock's going the other way, and net, this really reinforces, even though the massive stocks continue to move higher, and we think they do continue to move higher, that it is much more a market of stocks rather than a stock market.
But the funny thing here, coming from an investment banking correspondent, I think this is a funny thing to say, Wall Street isn't enough for me. If these Main Street businesses aren't really driving forward, if consumers are perhaps maxed out on credit cards, how much steam is there left in a consumer that is still feeling the pinch of higher rates? So
I think what you're seeing, again, is trade down in various areas. But in the final analysis, we think that there's plenty of liquidity out there. We also think, look, yesterday's number, it's no coincidence that yesterday's CPI sort of calmed the bond market, and today's PPI, the bond market is trying to sort of digest that in another way, because what we know is that the Fed is there. And it's not necessarily that the Fed put is going to be exercised, but the market feels good, and I think consumers are going to start to feel better about the fact that whether it's inflation moderating or the fact that policy is going to do what it needs to do in response to the incoming data.
I want to talk a little bit about the market action that we saw yesterday, because I think that yesterday was a pretty important day. It was kind of staggering to see the S&P 500 down almost 1%. You take a look at the equal weight index up by more than 1%. I really feel like we learned why concentration cuts on the other side. Is this the start of the great rotation? Do you have any confidence in calling that?
We do. Okay, but from that perspective, though, this isn't a, sell the Mag 7. We think that's one of these things that, you've had such enormous gains in those stocks that a period of digestion is normal. It's actually healthy. It doesn't necessarily need to drag the broad market down, which is what we saw yesterday, which is what we're seeing on the screen this morning. And for us, again, when you think about the long-term prospects of the market in general, you want to see small caps start to participate. Again, to your point a moment ago, Sonali, is like that is more of a ratifying the broader health of Main Street America.
Well, to your point on small caps, the Russell 2000 up, 3.6% yesterday. They were definitely participating in a big way. You did get a note of caution from Wells Fargo this morning, Chris Harvey writing that we believe the great rotation needs lower rates and earnings optimism. Maybe we have the lower rates coming, but when it comes to earnings optimism, are you going to see that broadening out just in the fundamentals of those smaller companies, or do we have to wait a little bit?
So that may take another quarter or two to develop when there's a greater sense of confidence that we are, a recession, perhaps will get pushed off in time or, furthering the soft landing thesis. But when you think about the small caps and you think about sort of that progression, they're trading at such a compelling relative discount to the S&P 500 that, this is the time for us where you need to start rotating there, and then the earnings come after the move has started.
My buddy Joe Bruce-Walis writing into the show and says, maybe we get more talk about the possibility of a cut in July. Is that, you just mentioned a Fed put isn't coming necessarily, but could we see it in July already?
It's not likely. Okay, the data hasn't deteriorated. The labor market data hasn't really deteriorated enough. It's one of those ones, again, the Fed doesn't need to. They have the luxury of waiting. And of course, this morning's data certainly is sort of a little bit of a sidetrack on that story. But in general, we do think they're on track for September.
To take the flip side here, when you look at the PPI data this morning, just a little bit of uncertainty, at least a choppy path to September here. What if we don't see that rate cut in September? What would that mean for equities?
Well, so here's the interesting thing. Remember, the story of this year is we started the year off pricing 6.5 cuts this year, and now we're pricing 2, and stocks have just rallied the entire time. It's much less about when the cuts are coming and how they're delivered, and much more about the confidence that the Fed is going to do the right thing. It's ready if the economy starts to turn down, which it has not. The labor market is softening very gradually here. And on the flip side, it's okay. The market is confident that the Fed will be patient if the inflation data unexpectedly starts to...
Do you think the economy isn't turning down? I mean, I was looking at Fastenal earnings this morning, 51 cents on 1.9 billion in revenue. The same quarter last year, 52 cents on 1.9 billion in revenue. And this is a company that, they supply everything to the industrial manufacturing base. The economy looks like it's slowing.
So I guess maybe it's no coincidence, or maybe it's a happy coincidence, that we're underweight industrials on the theory that the economy is slowing. But there is definitely a material difference between slowing and negative GDP.
Right.
And we just, to us, where the consternation would set in is if you really see the labor market start to crack. And you look at yesterday's weekly claims, we're not there yet.
All right, we're going to take a break, but you're going to stick with us. I want to ask you about, your call specifically, 6,000, and the choppiness that requires maybe valuation convexity. You like that?
That was good. That was very Tom Keene of you.
Yeah, let's get a look at some of the stocks moving before the opening bell. Besides the banks, here's Jess Menton. Jess?
Well, Matt, I'm taking a look at Tesla because it did snap an 11-day winning streak yesterday. If you look at this, though, UBS actually cut its rating on the stock to sell this morning. So if you're looking at that, they feel like the stock was rallying too fast, too fast, basically over that 11-day session. So that stock was down about 20% the first 6 months of the year. It was the worst actually point decliner in the S&P 500 at the beginning in the first half of this year. But of course, in that 11-day session span, it actually had gained about 44%. So you're seeing that moving there too. A little bit lower if you're looking in pre-market trading. But another one I'm looking at is Carvana. So obviously we know this stock can be quite volatile, edging a bit higher here though in pre-market trading. And really what's happening here though is that BTIG actually initiated coverage on this stock with a buy rating with a 155 price target. It actually closed yesterday around 130 there. So even though it's trading at a high premium, if you're looking at BTIG, they still think it's equally positioned against some of its competitors here. And of course, if you're looking at what's happening, it almost went out of business in 2022. But if you look over the last 18 months after it reached a deal with some of its bondholders, it's actually risen about 2,700%. So it's been quite a ride there. But if you are looking at what's happening with some of its over the last 2 weeks with high yield bonds, there's some issues there. So that's something to keep an eye on. And then lastly, Array Technologies, that stock's up actually more than 8% in pre-market trading here ahead of the opening bell. So Citi actually raised the stock to buy from neutral and is actually touting its growth potential. It lost about more than a third of its value so far this year, and there's been a lot of different issues. It had a CFO actually announce that it was going to leave recently. It also has some issues when it comes to project delays, but when you're looking at, especially with Citi, they feel like a lot of that pain, especially with compared to its competitors, is already passed, and especially the margin pain that it's had. But that is another stock to watch ahead of the opening bell, guys.
All right, a lot going on there. Carvana, I mean, up 265% in the last 12 months. We got to get Ernie Garcia on this program. Coming up in the next hour, Liz Ann Sonders, Charles Schwab, chief investment strategist, joins us. She says mega cap performance bias masks underlying turmoil in the market. And speaking of turmoil, Carson Block is coming on later as well. This is Bloomberg. Let's get to high interest. A look at what's making headlines around the world. Growing bets for Fed rate cuts probably gave Japan an opening to step into currency markets for a third time this year and prop up the yen. That's according to a Bloomberg analysis of central bank accounts. The scale of intervention was probably around 3.5 trillion yen based on a comparison of Bank of Japan accounts and money broker forecasts. The exit of Wall Street's last bear, Marko Kolanovic at JP Morgan, reminds many of a similar departure before the dot-com bubble burst. Now, if they're wondering if the whole saga is a sign of the market peaking, the fear is history is about to repeat itself, as the erasure of cynics is something that typically happens toward the end of market manias. President Biden downplaying concerns about his presidential campaign, but a series of high-profile gaffes during the NATO summit yesterday renewed concerns about his age and acuity threatening his presidential status.
I'm determined on running, but I think it's important that I allay fears by let them see me out there. Let me see them out. You know, for the longest time it was, you know, Biden's not prepared to sit with us unscripted. Biden's not prepared to, anyway.
And Julian, Emanuel of Evercore ISI still with us. And Julian, I guess we'll start there, and it's political risk. And I'm not going to ask you Biden versus Trump, but if you were going to invest on themes that come out of the election, when is the time to put on that trade? Some have suggested August, for example, but how are you thinking about it?
This cycle is very different, okay, because the volatility around, you know, the candidates, the news cycle, the conventions, all of that make this really, really unique. Look, the fact is a lot of what we would call, quote unquote, the Trump-related themes have worked in recent weeks, you know, and it's not a coincidence, as if you look at the polling and predicted and so on, the probability of his winning has risen. But there's also this thing that, you know, you tend to get sort of a peak in enthusiasm and interest once the convention is over. So I think it's one of those things that we're probably better off picking stocks, identifying things that we think are going to work under either administration, And, if you want to be tactical, there is a potential for that.
There's no themes? There's no Trump 2.0 themes that you can invest in? I mean, with big tariffs, with probably, I guess, the completion of the wall, with Mexico footing the bill this time. Isn't there anything you can do that you can pull out of that makes for a good 4-year investment?
Look, there are, and frankly, you talk to our energy analysts, and obviously it's pretty clear that energy is likely, traditional energy is likely to do better under a Trump administration. But a lot of it isn't quite as clear. Conversely, you talk to our semis analysts, and frankly, politics may not play all that big a role, even though you would think intuitively, based on our relationship in China, that it would.
It's really interesting to see the divergence in how investors are really baking in this possibility. Yesterday, we spoke to Steve Eisman over at Neuberger Berman. Let's take a quick listen about how he really weighed the benefits of trades versus investing in this environment.
100% certainty Donald Trump wins.
Interesting.
Really?
100%
Is that
certainty.
investable, though? What do you do?
Well, let's talk about why.
Yes.
So forget about, whether Biden's going to run. It doesn't matter at this point, to me, whether Biden drops out or does not drop out.
So he went on to talk about how the banks, for example, would be a trade. Do you agree with that?
I'm going to step back for a moment, and the concept, particularly when we look at the markets of the last 4 or 5 years, the concept of something being 100% certain is very frightening.
We did question him repeatedly about that.
As you got my title, we have derivatives in our title, we have quant in our title, and then basically, that tells you that 100% certainty is not something that markets typically tend to deal with. Again, there's been an enormous amount of noise in and around this, and let's face it, it's not even Labor Day. The amount of noise is going to get bigger. We were all glued to our TVs last night. We will continue to be glued to how this evolves. So to us, again, what it likely is that you get these times where emotion takes over, and that's where you get dislocations, and that's actually part of the recipe for, in a market that's in general very highly valued, you're still able to buy things low. And that's the kind of thing we're trying to do.
Well, speaking of 100% certainty and high conviction, let's talk about the state of forecasting. Obviously, your 6,000 call made a lot of waves, but it was interesting to see, for example, you had Michael Kantrowitz of Piper Sandler backing away from the practice of S&P 500 forecasting. And I'm just wondering how you're thinking about the state of your industry. Do you foresee more people, and perhaps yourself included, backing away from that practice?
We're not going to back away from a price target. It's just, it is, whether it's, a strict discipline or what it is, but it is one of the things that frames the ability to talk about markets in general, again, against the backdrop of there is no such thing as 100% certainty. Everyone knows that, it involves a range of outcomes, a particular path on the road. And frankly, for us, as you know, we revised our price target up drastically several weeks ago when we came to the conclusion that, that looking at the past, expensive markets, and this is an expensive market, tend to actually go on for longer and run further. So it's an uncomfortable reality, but again, it's our conviction.
Bull markets last about 5 years on average, right? And we're only 19 months into this one. We're up 50%, and typically bull markets would double that. I want to ask about buying low, because you said you still can. And you have this concept of valuation convexity for people who don't trade in options. Explain that to us, because you can definitely buy high in this market.
Yeah, no. So when you look at the quant factors, one of the sort of the head scratchers about the first 6 months of the year is that for the most part, valuation, as in buying lower PE stocks versus sort of using higher PE stocks as a source of funds, has not worked. And if you think about it,
but wait, so you sell like a Tesla, and then you buy something that's
the home
like
builders,
a Toll Brothers.
The home builders, for example, are and think about what we've seen in the last few days is the market is validating this idea where interest rates may not fall, but they're clearly capped to the upside. That's good for something like a home builder.
All right, Julian, unfortunately, we're running up against the clock. Got to leave it there. Hope to see you again soon. Our thanks, of course, to Julian Emanuel of Evercore
Next time
ISI.
we need to have him on for the hour.
I agree. At least half
There's a
an
lot
hour.
to talk about.
That's for sure. But anyway, coming up in the next hour, we'll be speaking with famous short seller Carson, the CEO of Muddy Waters. But up next, we're going to take a look at the companies making the most social buzz today in our Social Climber segment. This is Bloomberg. All right, it's time now for Social Climbers, the companies making the most waves on social media this morning. And first up, Bally's playing a winning hand today. The casino entertainment chain announcing a $2 billion deal with gaming and leisure properties for a permanent casino in Chicago. It's also unveiling a hotel redesign pending approval from the city. Next up, Ozempic may cut the risk of dementia by half, according to a new University of Oxford study. It's the latest in a series of trials designed to show the potential benefits beyond diabetes control and weight loss for GLP-1 drugs. Scientists are also studying whether the medicine can help treat alcoholism by reducing the urge to drink. And finally, AT&T says that hackers stole data from nearly all of its wireless customers. While there's still a lot of unknowns about the breach, it has the potential, if the data is released, to be devastating for some customers, including anyone who doesn't want others knowing who they are calling, such as politicians, executives, journalists, and their sources. Of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal, Matt.
That's great news about Ozempic.
Great news about Ozempic.
Because I'm worried about, I feel like I'm
Yeah.
a prime candidate for dementia. So,
No.
you know.
I think you need to give yourself more credit here. We're okay, Matt.
I am 50 years old. All right, coming up, more analysis on big bank earnings. We're going to talk to Chris Marinac, Janney Montgomery Scott, Director of Research. And don't forget, Carson Block is coming up. I've been looking forward to this for weeks. We're going to talk to the CIO and founder of Muddy Waters, find out what he's shorting today. This is Bloomberg. All right, we have about 30 seconds to go. No, 20 seconds to go until the opening bell. We have futures right now that are lower, at least on the S&P. You got Dow futures a little bit higher, Katie. In terms of the bell, look, the 99ers ringing it down at the New York Stock Exchange. These are members of the 1999 women's Olympic soccer team, U.S. soccer team, and that was really the beginning of this huge craze for women's soccer and really popularity in women's athletics. There you see the NASDAQ now above food, ringing the bell down there. And in terms of stocks today, it's been really a wild week. We had some CPI data that should have made the markets happy yesterday, but we came down. Even Tesla, Katie, ended its winning streak yesterday. What are we going to see today?
Well, it's made some parts of the market happy. Of course, the small caps, not so much. If you take a look at the big benchmarks, the S&P 500 down almost 1% yesterday. But so far into today's action, you can see actually a little bit higher, rebounding from those losses, up about 0.1%. The Dow leading the way so far, up about 0.2%. The NASDAQ 100, big tech, like you were talking about, took a bath yesterday, but so far up about 0.1%. We'll see if those gains can hold. But one stock to keep an eye on, as you mentioned, Tesla. It's lower today after postponing its planned robo-taxi unveiling to October, and as such, snapping an 11-day winning streak for the EV maker.
All right, I'm looking at telephone. AT&T suffered a massive hack of customer data. Separate from the one they reported earlier this year, the hackers got all of the mobile phone calling data and texting data from, it looks like, all of AT&T's customers. So it's one of the biggest breaches of private communications in recent history, and as a result, that stock is lower. Sonali?
And of course, I'm also keeping an eye on bank stocks. It was a very busy morning and a very mixed morning at that. JP Morgan Chase, despite posting record profit, Matt, you're now seeing it down almost 2% on the day. Wells Fargo down about 7% on the day. Citigroup, which has been flirting between gains and losses, now relatively unchanged, marginally down on the day, quickening those losses actually, down as much as 0.2%. Listen, what exactly is happening here? Let's flip up the board, because even though you had that record profit at JP Morgan, you did see provisions for loan losses at the highest level here since 2020, and you are seeing them rise exponentially or periodically as well. If we also take a look here at other metrics that we're looking at the banks underneath the surface, by the numbers, there has been this notion that Wall Street would save Main Street, that those Wall Street businesses, trading, investment banking, the rebound would really offset a lot of the hurt you're feeling in the consumer. But what you're seeing here is net interest income at JP Morgan alone is roughly 10 times what they bring in investment banking fees. That net interest income, of course, is tied to both corporations and consumers, but it is certainly meaningful, that number. And remember, across the street, there's a little more concern here about what is expected in those net interest income numbers more broadly. Remember, Wells Fargo missed on that estimate. Pulling up the board one more time here, looking at the banks that are reporting next week, you are also seeing some weakness here in Bank of America. Shares down 0.6% to start the morning. Goldman flat, Morgan Stanley up by about 0.6%. I'll tell you the reason why really quickly. Goldman Sachs more heavily weighted here to fixed income, very big in that business. It's where we saw a little bit of weakness relative to expectations for both Citigroup and JP Morgan. Also Morgan Stanley more heavily weighted in equities here. Both of these banks will set up for a stiff equities trading competition next week, guys. Can't wait to talk to you about it.
Well, let's keep the conversation going now with Chris Marinac. He is Janney Montgomery Scott, Director of Research. And let's start with the biggest of the big, at least when it comes to the U.S. JP Morgan shares falling from the bell. It seems like that record profit isn't necessarily being reflected by what we're seeing in the stock action so far.
I think that's right. We had a big day yesterday in the bank stocks, so I think you're giving some of that back. We've had a couple of good days in a row this week, so that's to be expected. I think as we transition into next week with the rest of the with the regional and national banks, I think we're still going to see reasonably good results. These companies are raising a fair amount of equity each quarter with retained earnings, and tangible book growth was really strong at JPM this quarter. Also positive at Citi and Wells. So we really like what we see overall. I think the points made earlier about higher provision is correct. Charge-offs are going to rise. I think the credit cycle is evolving. There are commercial risks that banks have to provide for. And so I think we're going to see more of that continue to play out.
You know, I was just reading through JP Morgan and thinking, what great news for the bankers, right? Investment bankers, trading, doing so well. For the women and men sitting behind their screens this morning, Chris, how strong is Wall Street job security?
Oh, I think it ebbs and flows each quarter. I think it really depends on how these markets behave, with a lot of the sort of national and international news that will continue to unfold. I expect we're going to see a back and forth market as the rest of this quarter in Q3 and year play out. It could be a very wild ride. Now, volatility historically is good for business and revenues, so that's not necessarily a bad thing, but I certainly think it's not going to be a one-way street for certain.
Chris, I want to talk about expenses here because it matters for the banks. It also matters for everybody else who's running a business. And if you look at how much patience investors have for anything that looks a little undisciplined when it comes to expenses, even if it's just regulatory costs here, how much of this is an issue here?
So expenses tend to be rising 0 to 1% for the biggest banks in the country. It's a little higher for your mid-cap and community banks, but overall expense discipline gets really good in the second and third quarter because your first quarter annual items for expense increases on Social Security and compensation, that's largely behind you. I think you're going to find that the FDIC special assessments go away. And I think you're going to find that the inflation impact on banks is going to get limited from here. So I actually feel pretty comfortable with expenses. They're not necessarily going to be zero, but I think they'll be modest on the growth rate.
And it's interesting, we're focusing so much on Main Street businesses here, even though Wall Street is showing some love. How about those Main Street businesses? How much juice, Chris, is there left in the consumer to max out their credit cards? This is all about these credit card businesses.
Well, sure. I think the juice is limited. I think most of the consumers have seen the big increase of their spending. I think the question is sort of keeping it flat. and not having it be a downside or a downtrend. At some point, the economy will roll over and slow, and that'll be a problem. I don't see it in the immediate future, but I think in terms of pushing further on lines of credit, I don't expect that to be a tailwind by any means for these companies.
Chris, I got to get your thoughts on Wells Fargo because the stock is currently down more than 7%, the worst day since March 2023. You think back to what was happening in March 2023, and needless to say, it was pretty bad. And I know there were some concerns when it came to Wells Fargo around credit quality and, of course, those expenses as well. But is it bad enough to justify the biggest drop since March 2023?
Well, I think investors are very sensitive to the revenue and earnings guide from Wells, and I think the fact that it was not as robust as investors wanted, plus the fact that the stock had a great Thursday, those are the two items why it's down this morning. I think that will work itself out as the day and next week play out, but I think that's specifically why it's open week today.
What's your take on, CRE and now I guess multifamily is in play as well? We're going to talk to Carson Block a little bit later from Muddy Waters. I know they're boosting loan loss provisions, but how bad is it going to get, Chris? And who's the worst? Who has the worst exposure of the big banks that Sonali follows?
Well, certainly, I think from the big bank perspective, CRE tends to be limited compared to your mid-cap companies. I mean, we had the New York Community saga earlier this year. That company is now on the road to recovery. I think overall, commercial real estate is in the early innings of its cycle playing out. So it's many quarters ahead where you're going to see loan loss reserves rise, credit losses starts to happen. I think banks are going to actually be selling real estate loans the second half of this year just to limit some of their concentration and limit some of their exposure. That's actually a healthy thing. That's why these reserves are rising. It's just a process. I mean, we have many quarters ahead where you will see CRE losses rise, but the banks have the earnings and the PP&R to stomach it. And I think it'll be a limited issue in terms of a distraction. I think it's more of a worry that is probably played out in the stocks already.
Chris, and I've got to pour one out here for the bank analysts. It's such a busy season, and it's not just the big banks. You cover a whole host of regionals as well. How do you feel about the regional banks' earnings season here? How much dispersion and perhaps pain might there be?
I think the pain will be limited. I think you're going to find that the cost of funds is flattening out. The companies are profitable. They're going to see reserves rise, but they're also going to see their profits be steady, if not slightly higher, from Q1 to Q2. I really like the fact that the bank balance sheets are growing on a limited basis, which means the capital retention is quite strong. So tangible book, tangible capital, those should all be rising linked quarter. And I think that will continue in the second half of the year. So from that standpoint, capital is really king in the banking industry. And I think we're going to see very good numbers on that regard.
Chris, great to get in touch with you. Hopefully we can talk to you again soon. Chris Marinac there of Janney Montgomery Scott talking to us about the big banks and the little banks. We're going to talk to a smaller bank a little bit later, so stay tuned for that. Coming up, President Biden's doubters grow in number, and so do his missteps. More on the fallout next. This is Bloomberg. Let's take a look at where we're going with these markets 13 minutes into the session. S&P 500 right now up 0.25%. 55.99 is the level. I think 56.35. Anything at that level, 56.34, 56.35 or higher would be another all-time high. NASDAQ up as well, and we put the small caps in there. So the Russell 2000 gaining after it took off yesterday on good CPI. Katie?
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, UBS cutting its rating on Tesla to sell. The analyst says that the EV maker shares have risen, quote, too much too soon on optimism over its AI plans. Remember, Tesla also pushed back its planned robo-taxi unveiling to October. You can see shares rebounding a little bit, though, after yesterday. Next up, we have BMO Capital Markets raising its price target on Microsoft to $500. The analyst cites rising cloud expectations, shares down mildly. And finally, we have JP Morgan lowering its price target on Estee Lauder to $129. Now, the cosmetics giant announcing earlier this week its CFO will retire. And the stock, it's been under pressure thanks to weak demand in duty-free shops in Asia, Matt.
All right, always interesting, that Estee Lauder story. Let's get, though, to politics. President Biden downplayed concerns about his campaign despite a series of gaffes at the NATO summit yesterday.
Now I want to hand it over to the president of Ukraine, who has as much courage as he has determination. Ladies and gentlemen, President Putin.
What concerns do you have about Vice President Harris's ability to beat Donald Trump if she were at the top of the ticket?
Look, I wouldn't have picked Vice President Trump to be vice president, but I think she was not qualified to be president. So let's start there.
For more on President Biden, we're joined by Bloomberg's chief political correspondent and surveillance co-host, Annmarie Hordern. So, Annmarie, this is, yet another make or break test. And it seems like as long as he stays in the race, we're going to be having these to look forward to each week. How do you think he did?
Well, also, it takes up all the oxygen in the room. Most of the questions yesterday in the press conference, and I was there, was about his age and whether or not can he continue in this race. I like the way Politico summed it up. Democrats are living in purgatory. Biden did a good enough job to keep his political life intact at the moment, but he didn't do enough to assuage these concerns, and that's because these gaffes overshadowed the press conference. And it started before the press conference even kicked off. He made that gaffe about President Putin. He meant to say President Zelensky at an event right before the press conference. So then the press conference became even more of a high-stakes event for President Biden. But when it came to some foreign policy issues, he was asked about Ukraine, he was asked about China, he was asked about the war in Gaza. He gave substantial, nuanced answers. And that's why you have these Democrats, as Politico's point, living in purgatory.
Something about this that I'm really curious about is actually Kamala Harris's role in all of this. What kind of pressure does this put, or what situation does this put the vice president in, given that there's so many eyes on her at this point as well?
Well, it puts her in a really difficult position because, one, her name is on the ticket as the vice president. So she cannot come out and say that she wants to challenge the top of the ticket, even though New York Times is reporting also quietly the campaign is looking at how she would do against former President Donald Trump. So this could be a breakout political moment for her, but she has to stand back because she is number 2 on the ticket. At the same time, if she was to move to the first place and if she was to become the Democratic nominee, the issue she has is that she's going to get a lot of questions about how much she knew about President Biden's condition. Were these just episodes or conditions, as former Speaker of the House Nancy Pelosi put it? And is she almost part of this? What some are criticizing the administration as potentially, are they complicit in this? Have they been covering up? These are the kind of questions they are being asked. So she's really in a difficult position. And at the moment, what she's trying to do is just campaign and talk about issues.
Well, Annmarie, just quickly to end it, let's talk about what Donald Trump was doing throughout all of this. And at the same time, he was meeting with Hungary's prime minister, for example. What message does that send to NATO, for example?
Well, I think it was very clear at the NATO summit that a lot of these leaders, and this was clear from my interview with Volodymyr Zelensky, Ukrainian president, last week, they want to understand what Trump 2.0 would look like, because this election right now is, a lot of the polls will show a toss-up, and it's even more challenging if you are looking that potentially it'll be, if you thought a month ago it would be a continuation of Biden, that's looking even more challenging following the debate performance. So there's a lot of consternation amongst allies about what the next 4 years will mean. And they want to get in rooms with either individuals that are close to the former president or used to work for the former president to try to have an understanding of what a Trump administration would look like.
Our thank you to Bloomberg's Annmarie Hordern. We really appreciate your reporting this week and very much looking forward to what comes next week, of course, for the RNC. And coming up, a breakdown on bank earnings. That and more in today's Wall Street Beat. Stick with us. This is Bloomberg.
This is Bloomberg Open Interest. Let's take a quick check on the stock market right now because we have a rally on our hands. The S&P 500 rebounding from yesterday's wipeout, currently up about 0.3%. Big tech even more. That was your big loser yesterday, and it's a winner today. Currently up about 0.4% on the Nasdaq 100. Interesting, though, that rotation that we were talking about yesterday, it seems to be continuing today because you have the small cap index, the Russell 2000, leading the way here, up over 1%. Sonali, it's going to be fascinating to see if this actually sustains itself.
Gotta love those small caps. But now going to some big caps, we're going to talk about the Wall Street beat, the most talked about stories in finance, starting with the big bank earnings, kicking off earnings season. JP Morgan, Citigroup, Wells Fargo, all reporting this morning. Really mixed results here. I want to talk a little bit about this idea that the investment banking boom has come back. Certainly it has. It hasn't, according to investors, shaken off that concern here about credit quality. Of course, Wells Fargo is feeling the brunt of that. But the CEO in the statement, interestingly enough, really tried to point out that they are really focusing here on that recurring fee revenue. Still, you see every one of these banks so far in the red by at least 2%, 7% or more for Wells Fargo.
Well, tell me a little bit about Citigroup because we were chatting before the show, and it's Wells Fargo, it's JP Morgan, then Citigroup has some idiosyncratic issues going on there.
Yeah, it's totally in a league of its own here because if you think about where the expenses are coming from, they just got ahead of it more than any other bank because of that big restructuring they really had to do, the reorganization. They're feeling the benefit now. Their efficiency ratio is down. Interestingly enough, a lot of the businesses that they said that they would focus on now, trading, for example, you're seeing some gains, equity trading blowing through estimates, and some of that investment starting to come back, though we know, and this gets us to our next story, the investment banking division still has some gains to go. And next up, we are going to talk just about that. Citi's new investment banking chief was granted shares worth $41 million to replace the compensation he gave up when he left JP Morgan. And of course, guys, as we've been talking about, this is all in an effort for Citigroup to really punch above their weight in the big leagues here.
I mean, $41 million is a big pay package even by Wall Street standards, right? I mean, this guy has enough money to buy his own private island now. What does that compare to in terms of, for example, CEOs across the street?
I've heard there are islands up for sale, but
yes.
beyond that, you know, even CEOs, to your point, if you think about the biggest banks, it's in the $20 to $30 million range in a given year. But this was a big hire coming from JP Morgan at the highest levels of their investment bank. JP Morgan is always top 3 in advisory. Debt underwriting, I've got to say, is where it would be the most interesting. JP Morgan brought in more than $1 billion in the quarter alone on debt underwriting.
Right.
And Citigroup less than half of that. It's an opportunity.
So $41 million, big headline there, definitely gets Matt Miller's eyeballs. It's interesting to look into the details of the compensation, how it's structured, because the award, it vests in 6 installments from January 2026 through 2031, and none of the award eligible for immediate sale. So some interesting details there.
Well, they want to keep golden handcuffs, right? That's what they call them at the end of the day.
I would happily wear them.
Yeah.
There's one more story here I wanted to talk about. Of course, finally, the biggest hedge funds are off to one of their best starts in a year, aided by stocks and quantitative investing, while those focused on macro trading are lagging behind. And guys, this also ties into the big bank story, actually. Don't get bored.
No, I'm not bored. I'm just saying, no. But the thing is, the average gain is 13%. That's what we're celebrating, right?
Yeah.
I would rather just buy the S&P. What's the cheapest ETF I can get?
Like 2 basis points.
Yeah, instead of paying 2 and 20 for less better performance.
Hey, listen, if you want to slam on the hedge funds, I won't mind it all day. Because, you know, you have to think about they're also operating at essentially max leverage. Remember, leverage don't come cheap these days.
Yeah. And what's the pitch, basically, that you have uncorrelated returns, you have diversified returns, but I guess
in the up years you don't make as much, but in the down years, do they protect you? Do they hedge against big losses?
That's the point. I think what's more interesting in all of this is that the macro funds are getting weaker, and you are starting to see that in the fixed income trading numbers at these big banks.
All right. Interesting stuff. Fascinating stuff, Sonali. It's a great day for you.
It's almost over.
There'll be more bank earnings coming out.
One more hour.
Let's get to the trading diary, what you need to be watching today and next week, really. Today, we're going to get University of Michigan, just a couple minutes, top of the hour, consumer sentiment. Bank earnings continue with Goldman Sachs reporting on Monday, followed by Morgan Stanley and Bank America on Tuesday. And then from Monday to Thursday next week, as Sonali mentioned, outside of banks, we'll have special coverage on the ground in Milwaukee, Wisconsin for the Republican National Convention. This is Bloomberg. 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And bank earnings are rolling in. JP Morgan posts a record profit. Citigroup beats on equities trading, but Wells Fargo warns cost-cutting efforts have started to slow.
From Wall Street to Main Street, we delve into the community banking landscape with Chris Maher, CEO of Oceanfirst.
And the next big trade, we'll be speaking to Carson Block of Muddy Waters, who will tell us where he's placing bets right now, Matt.
I am watching closely University of Michigan consumer sentiment coming out at 66. We were looking for, the survey was 68.5, and the previous month's reading was 68.2. So consumer confidence coming down a little bit. In terms of current conditions, which is one of the parts that economists watched very closely, 64.1 was the reading. We were looking for 66, and 65.9 was the previous month's. 1 year out, inflation is expected to be 2.9%. That's bang in line with the survey. And 5 to 10 years out, 2.9%. That's actually a little bit less than the survey, which is 3%, a little bit less. Both of those are a little bit less than last month's reading, which was 3%. So with that, it looks like the consumer is a little bit weakening. Katie, how do the markets react?
They love it, apparently. You take a look at the S&P 500, really building on its gains here, now up about 0.5% right now. And you can see the jump rate as those 10 a.m. data figures rolled in. You can see it, too, in the NASDAQ 100. Big tech now up about 0.7%, while bond markets continue to rally. Yields actually building on their drop from yesterday. The 10-year currently down by about 1 basis point, Matt.
Wow. You know what? The Russell 2000 gets a big jump as well. Now up 1.25% after yesterday.
You're a believer.
Well, you know what? It is. I believe that it is interesting to look at, especially in times like this.
If there's a rotation trade underway, we should probably talk about it.
Just 1 week to crack him.
The Dow is still fascinating stuff. All right, joining us to talk about it is Liz Ann Sonders, Chief Investment Strategist over at Charles Schwab. Sorry, Liz Ann, we have this kind of argument all the time. We have been having it for years about which equity indexes to put up on a triple board. Is the Dow still important to you?
I think it's for old folks like me. I think it's still a reference point. The biases in terms of where exposure lies at the sector level, obviously, is quite different from the S&P 500. So it gives you a little bit more of that cyclical exposure. It's price weighted, not cap weighted. So I think it's worth having on the list, on the board, so to speak, but it's certainly not the benchmark or reference point for most individuals or institutions.
Well, there you have it. I mean, I am in my 6th decade. I'm living in the second.
That's all I heard.
The second half of my century. Liz Ann, in terms of the rotation, I'll ask Katie's question, right?
Thank you.
Are we seeing the great rotation happening as we get closer and closer to a rate cut? Can you buy small caps? Can you buy cyclicals?
Well, it depends on what you mean by small caps. I mean, that's obviously a large universe. The Russell 2000's got 1,800 and change stocks, and they're not all created equal. What has been the real dividing line, not just including what happened yesterday, but the real dividing line for the past year has been around profitability. You've got about an 18 percentage point spread between the non-profitable stocks within the Russell and the profitable stocks. You can do the same thing if you look at zombies versus non-zombies, high interest coverage versus low interest coverage. And I think although yesterday was obviously a benefit to small caps broadly and in areas within that had not performed well, was the move down in yields in response to the CPI report. Looking forward, though, I don't think you want to lean into the lower quality areas that might have had their day in the sun or a short-term period in the sun. I think you want to continue to lean into higher quality, stronger balance sheet, strong free cash flow, high return on equity, obviously profitability, the non-zombies. And I think that's the best way to think about opportunities within small caps. There are times where it's okay to go down the quality spectrum if you're really pricing in a significant turn back higher in the economy. That often happens coming out of recession. I just don't think we're in that stage right now. So yes, look for opportunities down the cap spectrum, but stay up in quality.
Well, Liz Ann, should we be viewing the market right now through a factor lens? You brought up just a ton of them right now, profitability, cash flow, et cetera. I mean, is that the lens that you're applying to this market?
Yeah, I think this is not the kind of environment or market where you want to take a monolithic approach, either at the index level or the style box level, or even at the sector level, because there are opportunities as well as landmines across the spectrum of sectors and within style boxes. And I think taking that factor approach is the way to weed out and differentiate between the winners and the losers on those factors like profitability, valuation-based factors, strong free cash flow, high interest coverage. And I just think that that's a better approach in an environment where dispersion is starting to widen out and correlations are way down. That is very supportive of more of a factor-based approach as opposed to a monolithic sector or style-based approach.
You know, Listen, I really want to marinate for a second here on this University of Michigan data because it's interesting. Reading more through the data, you are seeing consumer sentiment falling below estimates, but you're also seeing year-ahead inflation expectations fall to 2.9% versus 3%. What does it mean for a consumer to be more pessimistic in this environment? What are the ripple effects?
Well, so one of the interesting things about UMich version of consumer sentiment relative to, say, Conference Board's consumer confidence is UMich. The sentiment measure is based on the questions that are asked. It tends to be biased more by what's going on in the inflation backdrop, whereas consumer confidence tends to be biased more by what's going on in the labor market. So that helps to explain some of the differentials. But specific to UMich and consumer sentiment, I think the reason why you haven't seen any meaningful improvement, even though we've been in this disinflationary path, we've seen, a metric like CPI come from a 9 handle down to a 3 handle, is that, all of us, the three of you on set, me, we all live in the minutia of this inflation data, and we're focused on the headline data and the core data and core services ex housing and how month-over-month readings track to year-over-year readings and what the base effects are, blah, 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 blah. The average human being out there thinks I'm still paying a lot more for stuff than I was pre-pandemic, period. And I think we get lost in the minutia of that, often forgetting that it's price levels that the typical consumer thinks about, especially the fact that the difference between non-discretionary and discretionary components within CPI is still a yawning gap. You're still close to 6% in terms of non-discretionary components of CPI, the stuff we have to buy and consume and use versus the non-discretionary components, which are actually at the zero line.
Yeah.
So I think that's what filters into the psyche.
I 100% agree, and I am also a consumer. So I care about the price of eggs and the price of cars. They're still incredibly expensive. The rent is too damn high, as everyone knows. So that's a real problem. How does this play out for the 493, Liz Ann? Because, the Mag 7, their earnings are insane. And as we get into earnings season, our own Bloomberg Intelligence notes that we could finally see growth for the rest of the S&P. Like the first time we'll see earnings growth for the 493 in 7 quarters. What are your earnings expectations as, economic surprises continue to be disappointing to us?
Yeah, so, and we don't publish our own earnings expectations. I don't cover individual stocks, but I can provide an assessment of what the consensus is looking into the second half of the year. And it is expected that by the third quarter, maybe latest the fourth quarter, you've had almost a complete convergence in terms of the expected growth rate for the Magnificent Seven, or maybe the largest 10, you can subset it in a number of different ways, and the rest of the market, where you see deceleration in earnings for the Magnificent Seven, acceleration in earnings for the other 493, such that by, again, third quarter, maybe latest fourth quarter, if the consensus is right, you've seen a convergence there. And that's something that we could start to get a clearer sense of, even though reporting season is for the second quarter when we have earnings season. But I think, just as been the case the last few quarters, I think that traditional metrics that are focused on, like the beat rate, percent by which companies are beat, they're arguably still important, but maybe more important would be the same for the top line growth. So beat rate, percent by which companies are beating on the top line, because that has been weaker than the bottom line. And then the relationship between the two obviously affects profit margins. I would also focus, and I will be focusing on the growth rate of the cost side of the corporate equation as a proxy for whether profit margins can be maintained, and if not, what is the answer to the question that analysts will ask, which is, if you still have to cut costs, where are you going to do it? Is it exclusive of labor or inclusive of labor?
We have to leave it there. Our thanks to Liz Ann Sonders of Charles Schwab. Thank you so very much for joining us on what has been a tremendous week here over at Bloomberg Open Interest. I want to also bring you some headlines as they come. Wells Fargo shares still on the decline. The CEO answering analyst questions on a call right now. Shares down more than 7% still. Charlie Scharf saying that it's up to regulators to make judgments about the bank's work. Heightened regulatory environment for the industry. I would say also in the JP Morgan call, heightened amount of questions about those capital rules. A sense here that things might get a little tougher down the road.
This, to me, is so fascinating because did they not see the Supreme Court Chevron decision? I mean, regulators have been rendered fairly toothless.
Can't fight the Fed.
Everyone's fighting what's been called in the halls of Congress Basel III, right? The Basel rules.
Those oregano rules.
I mean, and then you've got the possibility of a second Trump administration, which you have to imagine would also weaken regulation, including bank regulation, substantially.
The problem is these rules are still coming, like it or not. Even if they're watered down, they are still more than they were before. And so it will have some impact, and the uncertainty of that impact is what's spooking people a bit, Matt.
All right, but I think it's a really interesting story to follow, and you are doing that very well for us this morning. Thank you very much. Coming up later, an interview with the CFO of Wells Fargo. Speaking of, at 3 p.m. Eastern. Don't miss that on the close. But up next, short sellers have made over $10 billion in second quarter profits despite another S&P rally and what looks like an attack from regulators. We'll speak to Carson Block of Muddy Waters next. This is Bloomberg.
Shorting a stock purely because you think it's expensive is a death wish. You have to have a fundamental reason to be short a stock. I think the economy is fine. Is it slowing a little bit? Sure. Are delinquencies up a little bit in consumers? Okay. But there's no fundamental case to be massively short things.
That was Steve Eisman, Senior Portfolio Manager at Eisman Group at Neuberger Berman, speaking to us yesterday. Of course, one of the main characters behind The Big Short. But joining us now is a man known for his bearish best known for it. One of the few last standing activist short sellers really left out there. That is Carson Block, founder and CIO of Muddy Waters Capital. And would love to start with you on the environment here for a minute, because there is a lot of conversation about how difficult it can be to short in this market, particularly whether you call it a melt up, whether you call it a bull market. You certainly see even the unprofitable names or even some of the potentially troubled names moving higher. How do you feel?
It's never been a good time to be a short seller, I suppose. But a lot of what drives stocks these days, and your previous guest was talking about factors. And that's the thing. It's really so much of what moves stocks is really just flows into and out of index funds. So mainly into index funds. So as a short seller, you have to be attuned to that, and really you have to stay away from names that have significant passive ownership, because effectively that just shrinks the supply of the stock. And when you have inflows into those passive funds, they will buy those at any price. So that is something that has warped the environment and caused a disconnect between fundamentals and the prices of the stocks.
Carson, that's really interesting. We heard something similar from David Einhorn talking about how these passive flows have sort of just fundamentally changed markets. I do want to bring you some sound from our interview with Jim Chanos a month ago on the close. He had some interesting things to say about the state of short selling.
I've called this the golden age of fraud. So there's just so many companies, so many companies now that are playing games that are trying to take advantage of investors. So we need short sellers more than ever.
The golden age of fraud, of course, Jim Chanos' perspective that we need short sellers more than ever. But talk to me about the fundraising environment. I mean, is there investor demand for those short sellers?
Well, when I began raising money, so I was first an activist short seller, didn't have a fund, and then we launched. And my initial conversations, so we're talking 2014, 2015, were a lot of them flowed in the following way, which is, oh, you know, we're concerned about the valuations, we're concerned about the market, we want short exposure, but we just don't want to lose money when the market goes up. And it's like, well, you can't really have it both ways, guys. And since then, the environment's only gotten worse. I mean, Jim has shut down his hedge funds because, yeah, investors don't want to pay the price for that insurance policy that is your traditional short selling strategy. They don't care about alpha. And I'd say that also one of the things, to Jim's point about the golden age of fraud, yes, there are more companies playing more games. A lot of them are in the gray zone. You don't know whether it's over the line or not. So they're not going to get prosecuted in this environment. And some are over the line. But, I think that 2013 was a tipping point where on the long side, investors stopped being remunerated for caring about risk. And it became just about buying narrative. And so the long side investors who didn't make that transition, who still cared about risk, well, they became the butt of jokes or were derided as value investors. And I think that that's one of the transitions that David Einhorn went through, was realizing that you have to look at things differently than you used to. So that's the problem. Like, yes, the market needs more short sellers more than ever, given the amount of games that are being played. But if the long side doesn't care, then this can continue until it doesn't, basically.
So Carson, that's the sort of market's explanation. I wonder about the political issue, because during the Biden administration, the Department of Justice and the SEC have opened investigations into short sellers, accusing them of market manipulation. You would think that the Democrats should appreciate, speaking truth to power, holding corporate America accountable, pulling back the curtain and showing that it's not a wizard, it's a dude back there, So do you expect anything different if we were to have a second Trump administration, or do all politicians hate short sellers?
Well, it's interesting because just small correction, Ed, nobody has been accused of market manipulation yet. So to be fair,
just investigations, though, right, have been open.
Yeah, so I mean, look, we received subpoenas and search warrant back in 2021, which that's a day that I'm sure my then 8-year-old son will never forget. So yeah, I've got a real personal issue with this, but I think one of the things that I realized was at the SEC, when they were making these cases in 2010 to 2013-ish, based on work that activist short sellers had done, well, a lot of those people left the agency, and they now bill $2,300 an hour working for big law firms. So I'm not sure that the agency has much of an institutional memory of how helpful short sellers have been to it. Mm-hmm. And when you look on the whistleblower side, there's that SEC whistleblower program. It seems that the SEC is now trying to actually, contrary to the law, there's no law that states you're differently situated if you're a short seller versus company insider who's blowing the whistle. But it seems like the SEC is trying to make it harder for whistleblowers to actually get paid when the SEC has recoveries. So
right.
I chalk it up to no institutional memory, number one. And number two, there's this populism, right? There's political populism, but that's infiltrated the markets. Mm-hmm. And I think Elon Musk is really the first to recognize that in the markets and use that to push Tesla up. But I think that part of that populist message, it's easy to demonize short sellers
right.
as part of the populist message and somehow call us the suits. Well, that was a really weird moment in 21 when that started happening.
Well, Carson, wrapping it all together, I mean, you think about the regulatory overhang, the political demonization, it sounds like you'd call it, of short sellers, and then the fact that you have those market dynamics, all of that passive money coming in. I mean, do you see the short selling industry shrinking from here? What's the outlook?
Well, you have to differentiate the traditional short sellers who are not talking about the stocks they're short, and they're typically going to be short 50 to 80 names for fundamental reasons, melting ice cubes from what we do, which is we look for companies that have been generally, gravely misrepresenting the information they give to investors, if not outright lying. I think the former, that's a very difficult business right now because, it's just, again, there's this inclination to buy narratives, and allocators don't really want to lose money waiting for, paying for that insurance policy. For what we do, there's still, as Jim makes clear, right, there are plenty of companies that are problematic. The question always is whether investor apathy, investors in a given name, whether they're so apathetic that the problems that we find won't matter to them. And
Carson,
when you have an environment in which there's no enforcement, that contributes to it.
Carson, I want to switch gears a little bit and talk about sectors because you have been clearly targeting certain areas, and one of very high interest to investors right now, that is the commercial real estate market. You've had this short when it comes to BXMT, Blackstone's mortgage trust, and it has been down about 10% on the year. Clearly, you've made some money. But to what end are you looking to short this stock? They say they have $1.7 billion of liquidity. How much further are you going to go here?
Well, our thesis from when we unveiled it in December of last year is that in the second half of this year, BXMT is going to cut the dividend. So we're generally not forward-looking in what we do, but our BXMT short is different. And it was based on this information asymmetry. We got a hold of CLO data, so CLO loan data, which that's apparently emblematic BXMT's CLOs of what's on BXMT's balance sheet. So, I mean, a lot of these loans are in trouble. BXMT has not trued them up in terms of the risk ratings. So we believe that as more and more of these loans are allowed to pay in kind, that in the second half of this year, BXMT is going to have to cut the dividend. So that's what we're playing for in that short.
So if you think about what's happening now and this idea that you could see an interest rate cut, does that make the situation simpler for BXMT and other REITs? Do you think that this is a trade that you would continue into other areas, this higher for longer pressure on loan books trade?
So in December, when we went public with this, I mean, our view was that unless there were a roughly 300 basis point drop in SOFR within the next month or two, the BXMT would have to cut the dividend. So we've seen no decline. We've seen no decrease in SOFR, and maybe you're going to get a 25 basis point cut, before the end of the year, maybe 50 basis points. It doesn't matter in our view, because the problem is the borrowers had been protected from the interest rate rises because they put into place these they call rate caps. They're effectively interest rate swaps. And as those swaps burned off last year and are burning off this year, now they're exposed to the much higher interest rates. So that's what we think is the straw that's going to break the camel's back here.
What do you think about banks? Sonali's had a banner day with the big ones. Are there any that you would short, especially those that are exposed a lot to commercial real estate or multifamily?
Man, well, look, certainly there are some regional banks that could be interesting. In the past, in 2016, we were short bank OZK, which has a lot of exposure basically to niche CRE, doing construction lending. Now, at that time, it was also partly to say, look, this is trading at 2.5 times book because everybody thinks there's no risk here. It's such a great bank. I'm not current on that one, but if one were inclined, I would look at that.
All right, Carson, that's a good place to leave it. Unfortunately, we're up against the clock. Have to have you back on soon. That is Carson Block of Muddy Waters Capital, and this is Bloomberg.
This is Bloomberg Open Interest. A quick check on the markets here now, because of course we are watching really markets react not just to earnings, but of course tons of economic news. We have the S&P 500 now nearly 0.6%. The Dow Jones Industrial Average up about 0.5%, and the 10-year yield just about flat. But you have been seeing some movement in bonds this morning after PPI data this morning, and of course University of Michigan sentiment data. 10-year ending the week at 420. Now let's get a look at some of the stocks moving this hour. Here with us is Bloomberg's Jess Menton. Jess.
Well, Sonali, we have other stocks moving beyond just the big banks. Of course, I have to point out what's happening with AT&T. T is the ticker symbol on this. It actually came off of its lows earlier this morning, had been down almost as much as 4%. Of course, this came after AT&T did disclose it had a separate incident of a hacking in 2022. This is separate from what we heard earlier this year, so it affected users as far as when it came to text as well as some of their mobile devices for about a 6-month period in that span. But you're not seeing a bigger reaction because there's still a lot of news we still have to figure out with this. But another company I have to point out is Fastenal, because this is a big read and a tell on the economy. Obviously, this is a distributor when you're thinking about nuts and bolts, and a big read when it comes to manufacturing. It actually did beat estimates, and Bloomberg Intelligence saying those expectations came in better than expected. And also the company said that its CEO is still going to stay on tap as well. And of course, they do have a new, when you're coming with Jeff Watts coming into taking the president position there, because their CEO is going to move away from that, but still is going to be chief executive. And then, of course, we still have other banks beyond the big ones. We obviously know JP Morgan with those sort of record profits with the deal making there. But of course, you have other banks like y'all have mentioned with Wells Fargo, those cost-cutting profits and cost-cutting, especially when you're thinking about the efforts they're stalling a bit, and then Citi warning about some of those costs likely to be at the high end of the forecast. But then you also have BNY Mellon reporting, the oldest bank in the U.S., and that coming in strong there too with those expectations when you're thinking about not just the bigger banks, but obviously more regionals too. If you look at the BKX though, that obviously tracks when you're thinking about bigger banks and then obviously regionals that are comprised in that. If you look year to date, it's actually up 13%. So obviously still underperforming the broader S&P 500 today, just about marginally lower there. But of course, we will have more big banks coming next week when you're thinking about Goldman Sachs, Morgan Stanley, and Bank of America, of course.
Jess Menton, great roundup as always. You have a great weekend when you get there. But on the topic of banks, obviously commercial real estate an issue for many small banks across the U.S. And earlier in the hour, we spoke to Chris Marinac. He is Janney Montgomery Scott Director of Research on that topic.
I think overall, commercial real estate is in the early innings of its cycle playing out. So it's many quarters ahead where you're going to see loan loss reserves rise, credit losses starts to happen. I think banks are going to actually be selling real estate loans the second half of this year just to limit some of their concentration and limit some of their exposure. That's actually a healthy thing. That's why these reserves are rising. It's just a process.
And for more on the banking industry, I'm pleased to say we're joined now by Chris Maher. He is Oceanfirst Financial Chairman and CEO. Oceanfirst, of course, is a regional bank with branches in New Jersey, New York, and Pennsylvania. Chris, great to see you in person.
Great to be here, Katie.
I think you can guess I'm going to start with CRE because CRE, it's over 50% of your loan book. How are you feeling about that exposure right now?
Actually, we're feeling, oddly, we're feeling great about it. So, when you think about loan exposures, concentration is what kills. And there's this narrative that commercial real estate is all bad everywhere, all asset classes, all geographies. We operate throughout the Northeast, predominantly in 5 states from Washington to Boston. And we've always underwritten cash flowing real estate. So our portfolio has performed well, continues to perform well. So I wouldn't be surprised as we go into earnings season if you'll see kind of here or there, maybe some elevation by a bank or two. But there is no indication that we're seeing a broad-based commercial real estate issue right now. Certainly not across, multiple geographies or asset classes or all that. So we feel pretty good.
And interesting. So to that point, that 50% figure, it sounds like that's not something you're necessarily looking to push lower here.
No, we don't feel a need to push lower. It's something we've done well. We're a 122-year-old company. We've been around. We've been public for 26 years. And our history will show, whether it was the Great Recession, whether it was the dot-com bust, or even going through COVID, that our portfolios perform really well.
It's interesting, and certainly the market is really warming up, not just to Oceanfirst, but also more regional banks as well. Your stock is on a 5-day tear, right? And so if you think about also the impact of lower interest rates, talk us through what that means for deposits, what it means for net interest income moving forward.
Yeah, those are really the two big issues, right? Credit and rates. So when you think about what will happen with rates over time, and I'm not in the camp of, these massive rate decreases or multiple decreases. I think I'm more in the Jamie Dimon camp that we might see it flattish. We might even see it go up, and that's still a possibility. What that will do, though, as it rolls through our income statement and others, is it does take pressure off your funding costs, but it's not a light switch moment. So it's not like you're going to have a 25 basis point cut whenever that happens, and then you'll see a ripple through bank earnings in the next quarter. But it takes the pressure off, moves you in a different direction, and I think what investors are thinking about now is not what are your earnings the third quarter of 24. They're thinking about earnings trajectory for 25 and 26 and saying if the worst is over in rates and we've troughed in margins, then things are going to get incrementally better. And then the only question really is credit. I think that really, if you look at valuations, it's been overblown.
I'm going to try really hard not to bore Matt Miller for this one, but I have a question about the overall impact of bank regulation. Right. Do you think that this could ultimately spur more mergers and acquisitions? Would you be somebody that's willing to play in that consolidation story?
It's a great question, Sonali. So when you think about bank regulations, right, there are tens of thousands of pages of regulations, but when it gets to M&A and the rules under M&A, it can be very difficult to understand exactly what M&A would be okay, for your regulator. There's a little more clarity coming to that. The major agencies have come out this year and given us some guidance about things they think are productive M&A and things that are unproductive in M&A. So I do think there's an opportunity for that to improve regardless of what happens in the fall. But certainly, depending on the outcome in the fall, you could see that's an area of regulation that I think is a little bit more subjective and will depend a little bit more on who's appointed in various seats.
And you've tried it before, and we're sort of thwarted by regulation.
Yes. Yeah, we've had both experiences, Matt. So we've done successful M&A. We did have a deal a couple years ago that became complicated, and we just chose to move on.
I want to ask about, community banks are so important to the locals, right? I'm from Columbus, Ohio. My entire family uses Huntington, and all the businesses, they come to our weddings. Our bankers are like family. How hard is it as inflation has increased prices to a point where consumers are truly suffering, and at the same time, rates are climbing, so borrowing money to deal with those high prices is harder? How hard is it to serve your community?
Our customers are doing okay. And I think although rates are higher, and when we think about them in context of the last couple of years, they seem really high. Over a long term, they're not very high. And in fact, for most of my career, rates have been about this level, maybe even higher. When you think about the absolute level rates today, or even a quarter point change up or down in either direction, it does not radically change the cost of financing for a good business. But I will tell you, we're hearing from clients and folks that are particularly serving the lower income segments that you're seeing the consumer is under stress in certain areas. You saw that in the big bank releases this morning. They put aside reserves in credit cards, all three of the big banks, that were the most meaningful reserve bills that they had.
And given that you do have this unique perch as, a local bank, a community bank, I'm curious what you're seeing in the suburban office landscape. To bring this conversation back to CRE, when we talk about office, a lot of the time we're talking about, Manhattan pretty much. But what are you seeing in those more suburban centers?
Katie, that's a great question. Because when you look at suburban office, it's done really well, especially in the Northeast. We have, actually in our portfolio, our occupancy levels are higher than when we underwrote the loans. Kansas City Fed had a study out in April that I think is really worth diving into. And that showed that for large-scale office buildings, we're talking 500,000 square feet and above, the risk of default was strikingly higher than in small buildings. So at 500,000 feet, you've got a default risk of almost 25%. Small buildings, 50,000 feet and less, you're talking default rate about 5%. And at the end of the day, your dentist still has to come to the office, right? He's not staying home. So.
Chris, we thank you so much for coming in studio, joining us on our first week here. That is Chris Maher of Oceanfirst Financial. And coming up later today, an interview with the CFO of Wells Fargo at 3 p.m. Eastern. And coming up, the price to pay for economic growth. President Biden and Donald Trump have different economic approaches, but the federal deficit might be a common challenge. We're going to hear from Key Square Capital CEO Scott Bessent up next. Stick with us. This is Bloomberg.
All right, it's time now for our daily Wall Street Week conversation. Former President Donald Trump will pitch his economic proposals to the nation next week at the Republican National Convention, including his plans to tame inflation. Now, in a conversation with Wall Street Week's David Westin, key Square Capital CEO Scott Bessent says that it might still be too soon to call the recent data a victory.
I think if we look at the aggregate numbers, aggregates are good, but Chinese have a central plan, and they tell us they have a 5.5% the GDP target. So GDP looks good, but underneath the hood, there's some alarming things. The last jobs number, 50% of the jobs were created by the government. If we have government adjacent, which is healthcare and education, it was up to about 80%. Inflation is slowly coming down. The shelter number came down this month. And, I don't think the Fed needs to be in a hurry. They had been with this so-called dot plot, which I think they should get rid of because it's becoming an embarrassment for them. They'd been at 3 cuts for 2024. Just at the June meeting, they adjusted to 1 cut. And now the market is pricing in 2 or 3 for the year. So, it's all over the place. So, having been very wrong, why not take your time, make sure, and see what happens.
So maybe not in September for a cut, maybe not even November.
No, look, I do think that the bottom 50% of Americans are really having a lot of trouble, and that never augurs well. Statistic that's very interesting is the bottom 25% of Americans, their inflation expectations are twice the University of Michigan median inflation expectation. So the bottom 25% is seeing something different than the rest of the country.
So let's talk about what you think a second term with Donald Trump might mean for some of those very factors you're talking about, particularly that bottom 50%, the people who really feel that they're hurting right now. What would he do, given this economy, given that it's pretty good from most measurements, what would he do to really make it that much better?
Well, look, I think we're going to have to re-privatize the economy because this is running on government spending. We're at a 7% peacetime, non-recessionary budget deficit. This is unheard of. I have a piece out today saying for the first time, interest costs are exceeding our defense spending. So, the spending is now becoming also a national security issue. So I think we are going to go back to, under Donald Trump, the private sector pushed the economy. We didn't get inflation because the private sector impetus was met with deregulation. Under the Biden economy, they had big government spend, but it was met by increased regulation. That's the formula for inflation. So, I think we would see the tax cuts, Jobs Act extended. I think we would see a return to energy, a policy of fossil fuel dominance in the U.S. I think we could see up to 3 million new barrel equivalents a day, so oil and gas, off about a 20 million base. So push down energy prices, and once the deficit really is under control, we won't be talking about 1 or 2 rate cuts. We'll be talking about getting rates back down to 2%.
There's a lot of talk, as you know, about getting the deficit under control, but President Trump in his first term did not get the deficit under control. I mean, if you look at least the Committee for Responsible Federal Budget, they say under his administration, we added $8.4 trillion, and $4.3 trillion of that was not COVID related. We added a lot under Biden as well, but actually substantially less than under President Trump.
Yeah, well, they're using CBO projections, not the actual numbers.
Well, talk about taxes, because that's also a concern in that piece you refer to, Bob Rubin and Ken Chenault. They actually said there's a problem with the tax, extending the tax cuts that we had back in 2017. If you extended that, that would really substantially increase the deficit. Because only, and I think this is a CBO number, you correct me if it's wrong, but only 20% of those tax cuts actually paid for themselves.
Well, I think this time around, and I think with Trump 1.0, we got to stop the clock at the end of 2019 because COVID was a game changer, and I think that there is big appetite for pay-fors this time. So I think we would get this Orwellian named Inflation Reduction Act under control. I think you can save $1 trillion on that. I think if you empower states on Medicaid, that's another $1 trillion. I think that there will be some tariff income. So I think that there is a big appetite to reinstate the tax cuts, but with pay-fors.
And that, of course, was Scott Bessent of Key Square Capital with our own David Westin, who's sitting next to me on set. Really interesting conversation with a potential Trump pick there, of course, about Trump tax cuts and what they might look like under Trump 2.0.
Yeah, and he talks with the former president, I think, fairly regularly, and he gives him advice. I don't know whether he accepts it or not, but he has some view into what President Trump thinks about the economy. But you notice in that discussion, he really is emphasizing the bottom 50% or even the bottom 25%. It's really a populist message. A lot of the people he says benefited from this great economy are at the top of the income spectrum, not the bottom. Those are the people I think Donald Trump really wants to speak to.
Around this table, you got a couple of New Jersey gals, right? I'm a boy from Westchester. For us, these weren't tax cuts at all. In fact, my tax contribution has at least doubled, if not more, because the state and local tax deduction was taken away by Donald Trump in 2017. Do they intend to push that forward as well?
Well, I don't hear anything that they want to. And let's think about it for a minute. I'm not sure that Donald Trump is too worried about people in New Jersey and New York. He doesn't think they're going to get to vote for him anyway. He's worried about a different part of the population that cares a lot more. And they think, if anything, maybe we stick it to those those Easterners, who are spending too much, they would say, in their government anyway. This will get some fiscal discipline into New York and New Jersey.
Taxes used to be a boring topic, but the reality is it's pretty key moving forward. And there's this headline from the Center on Budget and Policy Priorities recently saying the 2017 Trump tax law was skewed to the rich, as you were saying, expensive, and failed to deliver on its promises, needing a 2025 course correction. Could anything be different next year if Trump were to gain office?
Well, it's interesting to hear from Scott Bessent. He is, to some extent, saying Trump 2.0 is not going to be simply an extension of Trump 1.0. I mean, you heard him say, if we can get our arms around the Inflation Reduction Act, we can save $1 trillion, or we can delegate to the states some of the Medicare, we'll save $1 trillion. He's looking at saving some money, which, of course, President Donald Trump, when he was president, did not do. If you look at the amount of money they spent, it did not curtail. In fact, the Manhattan Institute, which is not a hotbed of liberal thinking, the Manhattan Institute did an analysis of President Trump who said, actually, he added $3.9 trillion to the deficit, above what the line was they expected from the CBO going in. So he's got a little bit of a pivot to make to say we're going to save money this time.
All right, David Westin, great conversation. Of course, tune into Wall Street Week with David tonight at 6 p.m. New York, 11 p.m. in London. This is Bloomberg.
Let's get to the trading diary, what you need to be watching today and next week. Bank earnings continue with Goldman Sachs reporting Monday, followed by Morgan Stanley and Bank America on Tuesday. All of next week, Bloomberg is going to have special coverage on the ground in Milwaukee for the Republican National Convention. And then U.S. retail sales are due on Tuesday. On Thursday, we're going to get the European Central Bank decision, and that's a lot. That's already a lot. Do I need to go on?
No.
I'll stop.
Let's move on because it's been a big week for ETFs as small caps see the biggest flows in a decade or so. Athanasios Psarofagis, he is an ETF analyst with Bloomberg Intelligence. He joins us now for ETF Friday on set on a Friday. Obviously, yesterday was an important day in the market. You saw that rotation trade. Where did that cause money to move when you take a look at the ETF level?
Small caps was definitely the biggest. This is probably, I think, one of the most toxic relationships. It's like every year, everyone wants small caps to work. It's an election year. Everyone thinks it's going to come back. Money rushes into it. Performance always doesn't really live up to expectations, and it tends to move out. So anything just moving away from large cap, that was like really the big trade for yesterday. Equal weighted, anything not Mag 7, that's where most of the money tends to go.
I used to be on the ETF show.
You did.
With Katie
and
Eric. And we saw a ton of new ETF launches that just kind of started to taper off. How's that looking this year?
No, it's the opposite. It's ramping up. The launches are getting intense. They're getting intense. There is now 2x levered micro strategy in the filings.
Single stock ETFs?
Single stocks. I think it's like speaks to the frothiness a little bit in the market, right? Launches always tend to kind of follow how market sentiment is, and it seems like it's getting it's pushing the limits a little bit.
I'm going to play my role on this show and be the boring one again because
it's not boring.
TLT? What about treasuries?
Yeah, that's boring.
What about treasuries?
That's extremely important. Long duration bonds. Let's go.
That's an exciting one. That's not boring. That is finally starting to work. That has lost a lot of money for a lot of investors because they're always fighting the Fed, especially last year, and the Fed wasn't cutting. Finally, it looks like you might get a cut. That trade's starting to work. It's still, TLT is always a popular one. That definitely took in some money yesterday. It's on a 2-week win streak in terms of flows. So I think people are maybe starting to be more confident in fighting what,
Well, if you thought TLT was exciting, how about TMF? That is a triple leverage 20-year plus
Too much
treasury.
Fun?
It's almost too much fun. People keep pouring money into it. They keep getting burned. And I think that's so interesting that people just keep trying to make long duration work, just like they try to keep making small caps work.
Yeah, I think, it's anything levered up is obviously more exciting. But yeah, I think the two big things are going to be the Fed fight, that might continue on, and then trying to see if you can move away from the Mag 7, whether it's small caps or equal weighting or smart beta or one of these strategies.
All right, Athanasios Psarofagis of Bloomberg Intelligence, thank you so much. And tune into that ETF show, ETF IQ, every Monday at 12 p.m. Eastern. Matt won't be there, but I will.
And we're going to get another check on these bank stops before you let you go here. Of course, Citi's analyst call about to begin here, and it was a tough day for financials. We are still seeing JP Morgan down about 1.5% on the day. Citigroup now extending losses to 3.2%, almost 7% on Wells Fargo. Of course, another week of bank earnings ahead, Katie.
Yeah, a lot of red on that screen. We'll see how everyone else fares next week. The CFO of Wells Fargo, he joins Bloomberg TV at 3 p.m. Eastern. But that does it for Open Interest. I'm Katie Greifeld along with Sonali Basak and Matt Miller, and this is Bloomberg.